So I got some other questions. Which markets do you think is best to invest in, like in which country? And what do I think of cryptocurrency? Okay, which country do I invest in? I like to invest mainly in America, in American stocks, because I see that there is a lot of innovation happening there. Everybody talks bad about America. Everybody still wants to go and live and work in America. I think that's a very good sign. I think there's a lot of exciting things happening in that space. So I think there will always be fantastic growth in the American stock market. It's also because there is a lot of liquidity there. What do I mean by liquidity? There are some very small companies in Singapore which are listed. You can buy their shares, but when you want to sell it, there's not that many buyers. In the American stock market, there's always a great deal of buyers and sellers. So you don't rock the price too much when you buy or you sell. So what do I think of cryptocurrency? Myself, I'm not very bullish on cryptocurrency. I view it, you all would have studied the Dutch tulip bulb craze from years ago. I may be wrong. I have very close friends who are setting up funds to invest in cryptocurrency, arbitrage. But probably because I'm a more traditional investor, I like to invest in things where I can see the value. So people say cryptocurrency is a hedge against inflation. It's like gold. The difference is gold has some inherent value. If nothing else, you can use gold to make jewelry. You can use it to make wires for semiconductor industry. There are things you can do with gold. I can't see the same thing with cryptocurrency. So for myself, I personally don't like it. But there are some people who say it's just a gamble. There are investors who talk bad about cryptocurrency all the time. They say, no, I don't like it. But I put 2% of my portfolio in cryptocurrency because the price is going up every day anyway. So why don't I just ride this wave? So like I said, there's 1,001 different things to invest in. There's 1,001 different investment personalities. So I can't tell you what's the best thing. I would plead you guys not to believe those YouTube ads where they say, give me 10 minutes of your time and I'll tell you how to invest in the next big sure thing. Honestly, if those people knew what the next big sure thing was, they wouldn't have to sell you a program. They would just be mortgaging their houses to invest in the next great big sure thing. So think about it. Start thinking about investments today. You're probably not the age where you can open an investing account, but it's good to start thinking. Start thinking, what's your personality like? Do you like to take a lot of risk? Or are you the kind of person who is very, very affected even if you lose $1? Then you want to go for more stable stuff, but it's stable, means boring, means not so high returns. Okay, another question. What do I think of NFTs? Are they just pure speculation? I believe so. So you already know my stance on cryptocurrency. I guess also because I said I'm a more traditional investor, I grew up in a household where my father invested in traditional Chinese art paintings, those that you can hold, you can hang up. So I'm more used to that idea. And especially for me, maybe I'm not understanding NFTs well, but as far as I understand it, when you buy an NFT, you don't own the art. The person can issue NFT number 1 today. He sell it to you for $10,000. He can still issue NFT number 2 tomorrow. Sell that for $8,000. It's just a bit less because it's not the first. Number 3 for $7,000, and on and on. So I myself am not so fond of NFTs either. But just like those investors, if somebody wants to buy an NFT of one of my father's paintings, I'll gladly sell it to him. No problem. I'll take his Ethereum, but then I'll convert it to US dollars straight away. After you have invested a certain amount, if say you need it for another purpose, is it possible to withdraw a fraction of the total amount and let the remaining money grow? Yes, of course you can, which is why I like shares. So if you buy a house for $2 million and you need $100,000 today, you can't tell someone, hey, I'm going to sell you a room for $100,000. You got to sell the whole house. Right? And every time you get in and get out of an investment, there's commissions to be paid. So in Singapore, for property, there's stamp duties. When you buy and sell shares, you have to pay a commission to the stockbroking firm. But of course, if you buy shares, let's say let's take a share. Let's say Tesla was about $900 this morning. If you buy 10 shares in Tesla, you have invested $9,000. And let's say for whatever reason, you need to pay your school fees, you need $900. Sure, you can just sell one share in Tesla. You collect your $900 a couple of days later, you use it to pay your school fees. You let the remaining $8,100 worth of Tesla shares continue to be invested in the stock market. Yeah. And it's always a great idea to, some people have this thing called regular savings plans where they commit every month out of their salary of, let's say, $5,000, $1,000 you will invest in shares in the stock market. Okay, another question. Is there a minimum number of shares you have to purchase when you buy stocks? Okay, different stock exchanges around the world have different rules. In Singapore, normally when you buy shares in a company, you buy one lot. We call it lot, LOT, which is equivalent to 1,000 shares. You can buy less than 1,000. You can buy 500. You can buy 400. This is what we call an odd lot. It is allowed, but it's harder to sell. So if you have bought something and the share price today is $10 and you want to sell 30 shares, you can sell it, but you're not going to get $10. You're probably going to get something like, let's say, I'm just putting a number out here, $9.70. So a lot of people in Singapore prefer to buy a whole lot in lots of 1,000 shares. In America, which is another reason why I prefer investing in the American Stock Exchange, the New York Stock Exchange, is you can buy one share. You can buy one share of Berkshire Hathaway. You can buy one share of Microsoft. And certain trading accounts, they even allow fractional ownership. So if you can't afford the $320 odd that Microsoft is going at, you only have $100. You can buy a fraction of the share. But I'm not very familiar with the rules behind that because I have difficulty keeping track of whole numbers as it is. I don't want to keep track of fractions as well. Yeah, so things to consider. And nowadays with globalization, you know, when I started out trading, it was really, really difficult to open a trading account for different countries. Nowadays, it's so easy. So there are some trading accounts where when you open up, they immediately open up, give you access to trade in the Singapore Stock Exchange, the New York Stock Exchange, the Shenzhen Stock Exchange, the Shanghai Exchange, Hong Kong Stock Exchange. With increasing globalization, these are becoming very, very easy to do. You can even have great savings. So when I started, I could only use a trading account from a local bank. And for each trade, I typically paid a few $100s in commission. Now I use another one and I pay $1 for every trade that I do. Okay, another question. What is short selling? Okay, vis-a-vis the GameStop crisis. So short selling is, now, let's take an easy example first. You buy an apple, you have an apple to sell. Short selling is when you go up to someone, let's say I go up to my buddy Ben and I tell him, hey Ben, I'm going to sell you an apple that I don't have right now. I'll give you that apple a week later. And why do I do it? So let's say apples are going for $1 each right now. I tell him, hey Ben, I'm going to sell you this apple, which I don't have right now, a week later for $1. That's the price in the market right now. And Ben says, sure, I'll take it a week later. I don't mind for $1. I'm hoping that in 1 week, apples are not going to be $1 anymore. I'm hoping that in 1 week, nobody in the world is going to like apples and apples are going to cost 10 cents. So if that happens a week later, I'll go to cold storage or NTUC or wherever. I pick up an apple for 10 cents. I walk over to my friend Ben and say, hey Ben, here's that apple we agreed to trade on a week earlier. I paid 10 cents for it, but you're stuck buying it from me for $1. So you make a difference. And that's what short selling is. Short selling can be very scary. Now, if I buy an apple for $1 today, and a week later, nobody in the world wants apples anymore, so their price falls to zero, I've only lost $1. Right? I throw away the apple, I lost my $1, I'd be done with it. If I did the same short sale, I go out to my friend Ben and I said, you buy this apple from me a week later for $1. Okay, agreed. And a week later, a virus has wiped out all the apple crops in the world, and apples are now going for $200 each. I still have to go to NTUC and buy that $200 apple and sell it to my friend Ben for $1. So I'm out $199. So when you short sell, your losses can theoretically be infinite, depending on how far prices have gone up. So my advice is for most people, don't engage in it unless you are a very, very seasoned trader. Yeah, personally, I've never done it in my life. Bit too scared to do it. But there are people, there are companies like Muddy Waters, which make money off short selling. That's their specialty. So so in stock market parlance, if you believe prices are going to keep going up, you're called being very bullish. If you believe prices are going to keep coming down, you're considered bearish. Okay, another question. Is broker commission standardized in a market? So broker commission is not standardized. Different people charge different things. So for example, when I was in private banking, even for very, very big clients, we may charge them, we may even absorb the cost of their commission. We may say, oh, Mr. Client, thank you for putting $1 billion with me and we are earning good money off that. So anytime you trade, we are just going to absorb all your trading costs. If you are trading through the banks, through broking firms, you can just look up on their websites. Usually they'll tell you what are their charges. So there's anywhere from free to hundreds, thousands of dollars. But if you're looking at a free one, please look at the fine print. Usually there's some terms and conditions attached. Nothing is for free. Yeah, so when you are of age or with your parents, go take a look, see which trading accounts you like. There's so many out there. There's like TD Ameritrade, Charles Schwab, Interactive Brokers, Tiger. Assess the risk for each. Like I said, my father is very traditional. When I first told him I'm using a certain online broking firm, he was going like, how do we know they're reliable? How do we know he's not going to run away with all your money and close down tomorrow? I said, yeah, it's a listed company. The guy's worth a few $1 billion. He's not going to run away with my $1,000. So yeah, another reason why companies like to go and be listed on a stock exchange is because it gives people a vote of confidence. If you're listed on a stock exchange, can you go out of business? Sure, you're going to go out of business. Can you commit fraud? You can commit fraud. Are you very likely to do it? Not as likely. Okay, some other questions. What is the best way to assess risk on companies and brokerage firms in the stock market? Okay, so brokerage firms, like I said, you look at their track record. If they've been around 50, 60 years, if they're making money every year, unlikely they're going to try and cheat you. Risk on companies is a very, very difficult thing to measure. So for one thing, you want to start looking at their financial statements. If the company made $1 million 3 years ago, made $2 million 2 years ago, and every year they've been growing, probably not so risky. It seems like a well-run company to me. But nowadays, companies are very different. So my father was a commercial banker. What his job was to issue loans to companies that wanted to borrow money to grow. So the first thing he told me he would always look for, are you cash positive? Are you making more money every year than you are spending? If you are, I'm more willing to lend the money to you. But nowadays you can see huge companies like Tesla. Tesla was losing money for years. And now they are in the black and they are one of the darlings of the stock market. So how do you assess that risk? If I had shown Tesla's balance sheet from 10 years ago to my father, he would have told me I'm crazy. But now I'm telling him he's crazy for not buying Tesla 10 years ago. So, but if let's say you just want a pure risk perspective, look at the financial statements, see how well they're doing. If they have more assets than liabilities, they're probably safe as well. Or even if they go under, since they have more assets than liabilities, you might be able to get some money back if you are an investor in the company. Another way you can assess risk is by looking at various ratios that analysts will pull out. So a very common one is what we call the price equity ratio or PE ratio, a price earnings ratio, sorry. So if a company is earning $1 per share and the company is selling their shares at $10, they have a price earnings ratio of 10. The higher the price earnings ratio, the more risky a bet it is. Because if let's look at two competitors, and AMD and Intel. They both make chips for computers. If Intel's shares are selling at 10 times the price of their earnings, but AMD's is going at 100 times, I have to ask myself, why is AMD selling at such a higher price? Is it justified? Are they really 10 times better than Intel? Are they earning 10 times as much as Intel? Are they doing things 10 times better? Or is the price just overinflated? Have too many people been hearing about AMD Ryzens, not knowing what an AMD Ryzen is, and just saying, I keep hearing people talking about this thing, let's just buy it, and they push the price up? Or is it really justified? So once again, there's no best way to assess risk. There's a lot of things that you can look at, too many to cover in this short segment today. But it's because everyone has a different perception of risk. I look at AMD and I say, it's too risky. I want to sell it today. Another person is going to look at AMD and say, I think it's too cheap. I think they're a great company. I think they'll continue to grow. And then we have a trade. I can sell and someone will buy. If everyone were to assess risk the same way and we all say, this company is too risky, we're all going to sell it, it's way too dangerous, no one is going to look at it and say it's not that risky and buy it, then we'll be stuck. So there's always different perceptions, different people will be buying, different people will be selling, and that's how we make a market. So if you are looking at, that's another topic, if you are looking at investing in the stock markets of other countries, you have to take note of the time differences, the different times that they are open. Like Singapore, we do it from 9 to 5. US is from 9:30 in the morning Eastern time till 4 p.m. Then there's other things to look out for, like although the US stock market officially opens at 9:30, they have a pre-market that opens from 4 a.m. all the way to 9:30, and then they have a post-market where you can still buy and sell shares that's open from like 5 p.m. to 8 p.m. So yeah, I wake up in the middle of the night to check stock prices. Oh, so how do people trade aftermarket? So some trading accounts allow you to trade pre-market or aftermarket. It's just an option that you have to tick that says you are willing to participate in trading outside of traditional market hours. Some people like it because they say, wow, I got a big tip that Microsoft is going to introduce 3D holographic video conferencing. We don't have to look at flat images anymore. It's going to be the next killer thing. I want to start buying shares in Microsoft before everyone else hears about this news. And Zoom is going to collapse. Nobody's going to want to Zoom anymore. The shares are going to be worth nothing. I want to sell all my shares before people hear this news. So you would go into the pre-market and start trading. There are dangers because there are less people trading. You can imagine not that many people will be awake at 4 a.m. New York time to do trading. So the market is not as liquid sometimes. You may not be able to sell all that you want to sell or buy all that you want to buy at a certain price. How important are dividends when it comes to buying? Okay, the next question is a good one. How important are dividends when it comes to buying a stock? So that depends on what you're looking for. Like I said, it depends on your risk profile. If you are very risk averse, you can't stand the thought of losing even a single dollar on any investment, you might want to consider a stock which pays a lot of dividend. When they earn money, let's say they earn $10 million, they'll say, oh, I had a great year this year. Usually I only earn $1 million a year. This year was a bumper year. I had $10 million in earning. I want to give some back to my shareholders to reward them for investing in me and staying invested in me. So they'll say, out of the $10 million, I'm going to pay out $5 million in a dividend. And you can say like that accounts for, that's like a 5% or 4% dividend yield. So if their share price was, okay, I won't get into that, it's a bit technical. So they pay out dividends. So some people buy a share because they feel the share price is not going to move up or down much. It's probably going to stay at this level, but they pay me a great dividend. They pay like 7% dividend. Inflation is 5%. Bank interest rates are 1%. I'm getting 7% from this company. I want to buy this. So they said, I'm not looking at the share price. The share could be $500 a share, but I don't think it's going to move anywhere. I just want the steady income that they're going to give me every year. The steady 7% of my investment that they're going to pay me every year. And that's fine. That's a valid strategy as well. There are other people who are young. They say, I'm 25 years old. I don't have a wife. I don't have a kid. I just want to grow my money as fast as possible, because even if I lose all my money, I'm still at an age where I can earn more and more money every year. So I'm going to take my gamble on NVIDIA. They pay hardly any dividends, but I'm looking at their share price doubling in the next 5 years, kind of thing. So again, it's on your investment profile. Typically, I would say people who buy a stock for the dividend are more risk averse. They want to know that at the end of this year, I'm earning 7%. They don't want to take a risk on the stock price. So there are different ways that the dividend will interact with the share price, and that's another whole big topic. But usually I would say dividends are for more risk averse investors. You're looking for high dividend paying stocks. And what we call growth stocks, those which you see the potential for the price to go up a lot in the future. These growth stocks are for more risk-loving people. So again, these are all great questions. Think about them. Think about where you lie. I used to think that I was a very safe, prudent investor. I just want to buy all the big MNCs. But as my portfolio grew, I found that I had a bit of extra capacity. I could devote some of it to taking few riskier investments, and I was fine with that. As my wife and I changed during our marriage, she got promoted more and more, and we said, okay, you're earning a lot of money and more than enough for the family, so I can afford to take riskier investments that could potentially lose all our money or double our money. So when we come to budgeting, these are things you need to discuss and review as well as things change.